The Quantum Group USA, LLC in California, DBA Quantum Distribution and Insurance Services. Advisors are responsible for following all insurance, DOL, FINRA, SEC, broker-dealer, and compliance officer approval requirements prior to distributing this information to clients. Welcome back to May's edition of More Market Insights, powered by Quantum. Well, lots going on. It's been a pretty remarkable stretch in the markets. Not long ago, we were having very different conversations, concerns about a pullback, increased volatility, and whether the market was starting to roll over. And now, just weeks later, we're back at new all-time highs. The kind of move raises some important questions. What actually changed? How sustainable is this, and what should investors be paying attention to from here? And at the same time, the Federal Reserve is in some interesting spots with a more internal disagreement than we've seen in quite a while, and growing attention on what leadership could look like going forward. Joining me as always is Andy Moore, Vice President of Advanced Planning and Portfolio Solutions at Quantum. He works closely with advisors on translating these macro shifts into real-world investment decisions. Andy, as always, it's great to have you with us.
Morning, happy Monday.
Happy Monday.
Crazy
yes.
30 days since the last time we spoke.
And I guess we start with the obvious. What actually changed in the last 30 days in your mind that took us from where we were and to where we are now?
When we spoke last month, and even off camera, I thought the market was looking for just some sort of catalyst to move higher. It looked like we had bottomed a couple weeks prior to that, and when we sat here, I referenced it, Taco Tuesday, which is Trump always chickens out. And we had that deadline, midnight. If Iran didn't, have some sort of small agreement on a ceasefire, he was going to obliterate, Iran. We've got the 24th hour, so to say, an agreement. Market marched higher from there and didn't look back. Plus, we had really strong corporate earnings so far this year. Mag 7's pretty much reported, all stellar reports. 4 to 7 are basically higher. So I think it was just a catalyst that, and the investors were looking for a reason to move the market higher, and they got it.
And you are, again, Nostradamus, so you were talking about a V-shaped recovery. Nobody else was really talking about that. What were you seeing that other people missed at that time?
I think from a sentiment perspective, like I just said, it had looked like the market a couple weeks prior was trying to put in a low, and was just looking for that catalyst. And when we have as much negative sentiment around the war, on TV, so to say, the rhetoric, is telling a story that sells viewership, so to say, but underneath the surface, there's a ton of cash on the sidelines. There was a lot of shorts that came into the marketplace. So when you get a catalyst along the lines of a ceasefire, get the short cover and cash comes in. What's ironic here is, typically the retail investor would usually lead these rallies with the buy the dip mentality they've had for years and years. Retailers kind of miss this one, which is it's going to be interesting to see if they actually want to come back into the market on a bigger scale. This was really led by the institutional, the hedge funds, getting back into the market. So I think on this rally, big money made money. I think the retail investor was left behind a little bit.
Would you call this rally fundamentally driven in one sense, or is it just based on positioning and liquidity?
I think the last week, 10 days was a little bit of fundamental. We talked about, probably 2 months ago, keep an eye on semiconductors, right? So software stocks have been in a bear market since really fourth quarter of last year, and I do think they've bottomed. I had mentioned before, we had an advisor or firm, take a bunch of free partial withdrawals out of the SBL product that has big liquidity, and they're buying software stocks. So think your more Microsofts and Oracles. But semis, got down to support and really never broke down. And if you look at the semiconductor rally, that was really what kind of got us over the hump on, when you look at April, S&P was up 11%, NASDAQ up 18, 19%. Historic, 18-day run here. But the last 10 days, I was alluding to, earnings have been really good. We talked about the rotation from growth in the value. A lot of our vol control indices were doing well. This rally was led by growth. Semiconductors in particular, Mag 7, like I said, just had good reports. Meta didn't fare so well, even though it was a good report. They were down. You had Amazon, Google's at new all-time highs. Microsoft's trying to find a bottom. So it's kind of more of a growth rotation out of the value. What's interesting is small caps have probably outperformed all of them. So we had talked about months and months ago, keep an eye on small caps. Small caps at new all-time highs and seem to be leading the charge on a breadth expansion. So I think it's a little combination of everything.
So at these levels, where do you think the biggest risk is? Is it really valuation or is it like policy?
I think it's going into policy now. Valuation still, when you look at historically, go back to the dot-com bubble, still not stretched to those. When we look at forward earnings, if the companies keep posting these record revenue and earnings, we're decently valued, but we're not overvalued. So I think it comes down to policy. We've got a lot coming up through the summer. Summer's usually, there's a saying, sell in May, go away. Hasn't worked the last few years, but we've got, new Fed confirmation coming up with Kevin Warsh, but then midterms. Everything's about redistricting, remapping. Midterms are going to be interesting.
Let's go to the Fed now. So they're at a bit of an inflection point right now. How would you characterize their stance right now? Because, as we said when we were opening, it's a little different kind of environment for them right now.
So I would say it's internal division. I think there's a lot going on behind the scenes that we don't even see in the public. Powell, just oversaw his last, Fed meeting last week. The next one's in June. You got Kevin Warsh's confirmation mid-May. I'm assuming he's going to get confirmed. It sounds like he had some good Senate hearings a couple weeks back. So I think there's a big division on which direction to go. I'd say it's kind of rate neutral right now. You're going to have a lot of the pundits come in and think Warsh is going to be Trump's little puppet. I do think he's going to be independent. I think there's a little bit different focus for him. Instead of data dependent, it's going to be a little bit different. But it'll be interesting to see where we go with the Fed. And going back, and I think a lot of advisors may not realize this, and you and I have talked. I still think there's another correction coming before we have a really big end-of-year liftoff after midterms. But I think it was Tom Lee, Fundstrat, which I follow quite closely, put a stat out, which I wasn't even aware of. But when a new Fed governor comes in, not governor, but Fed chair comes in, the market likes to test that Fed chair. The first month we're typically down after confirmation, so we're looking at kind of June, right? If he gets confirmed mid-May. First month is down 5%, 3 months is down about 10, and 6 months down 18. In around those are the averages that they're down. At the end of 12 months, markets are typically up. So the markets want to test the new Fed chair coming in June. That's where you get your market pullback, I think.
And you said we can't see behind the curtain, right? But do you think that this is really, it's disagreement, or is it confusion, or are we looking for a meaningful change in direction, do you think?
I think it's disagreement on where inflation is right now, to be honest with you. You may have one or two that maybe play a little bit of the politics. There's one dissent that wanted a rate cut, which I don't think you're ever going to get that. With where we are in the war, which supposedly has ended. But when you have a blockade going on and ships can't get in and out, it's still inflationary. And I'll get back to that because an interesting chart on the crude oil. But back to the Fed question, is inflation transitory again? Which Powell said it was, and he was completely wrong. And then we had runaway rate increases. I do think it could be transitory if we start getting these ships to flow a little bit more normal routes. You see a lot of them coming to the U.S., the fuel. That costs a lot of money when you got to travel down around South Africa and across the Atlantic to get your fuel. So I don't know. We'll see, but I do think it's data dependent. Some think we're going to have runaway inflation. Inflation's been the highest now in 3 years. So does it stay elevated? Hopefully not. Oil's a big play on it.
Let's talk about strategy now. So Quantum Life powered by ORG. How is that performed in this sort of fast-moving, kind of unpredictable environment?
So we rolled that out April 1st, right? So we're 30 days in. the response has been unbelievable. The One Resource Group has done an unbelievable job of turning around illustrations literally in a matter of 15, 30 minutes. There's always some hiccups when you roll out a partnership with integrations and things of that nature. You know, the advisor feedback that have used it are asking why we didn't do this years ago. Well, we would have done it years ago, but we didn't have the relationship with One Resource and integrity to kind of roll that out. But it's been an unbelievable rollout. Premium is up. A diversification on carriers is helping. The one thing that I would say that sticks out to me, because long-term care has been a question for a couple of years. You know, we have some annuities with LTC riders in it. Lisa over at One Resource Group has done an unbelievable job as far as responses, but the advisors that are looking for long-term care didn't realize there are so many options and different options. You know, then we have, you know, One Health, so we've had a couple firms and advisors jump on the health insurance bandwagon, so a different revenue stream for them. But for the first 30 days, it's been unbelievable. It's only going to get better.
So then looking back the last 30 days, and you've mentioned some of what you expect, but you know, going to the end of the year, what do you see happening, and what are the most important things to watch for?
For the One Resource markets, I would let's stay on the Quantum Life powered by ORG. I think as we get adaption, we're going to have a webinar on the 19th live, so that way it won't be chats. We'll put it in the chat box, so to say, questions, Q&A. But me, Jimmy, Tony, Todd will be on that call, walking advisors through, you know, illustration requests. We just launched a new illustration design page on Friday, contracting, moving contracts, so we get additional carrier exposure. So, you know, keep an eye out for that. I think that the life department, you know, in due time will be on the level playing field as our annuity department. Pivoting to, I think, what advisors really want to hear is, you know, our take on the markets. I'm still not changing my stance. I do think we're higher at the end of the year, but I do think there's another big drawdown coming. Going back to you asked about the Fed and the transitory inflation. Oil broke a major uptrend line last week. It points back down to $75. If we can, we'll probably get a bounce in the test of that trend line, but trend lines are pretty important when you look at a technical analysis. Again, if we can get some ships flowing through the strait, oil looks to be pointed towards $75, which will help on the inflation front. And I've made a case, I think you can see it potentially under 60. You know, markets overshoot up and down, so that could be a possibility. But yeah, I still think there's a bigger, you know, correction, or at least a market neutral mentality going into midterms. The bonus products that we have, probably our number one sellers still. You know, North American and Nexus just raised their bonuses. That SBL Top Ridge with the 20% bonus and big liquidity is a top seller. So, you know, we still see advisors taking advantage of S&P 7,300 right now. You know, if you take a 20% bonus, you're up over $8,500 cost average in, you know, maybe in the fall. But, you know, I do think markets are poised to, after a correction, go higher. I actually think when we get through midterms, you may see a historic run. You know, when we look at irrational exuberance, I had a couple questions, you know, recently, you know, especially with the semiconductors going vertical. NASDAQ up 18% in 30 days. Is this that irrational exuberance? Valuations aren't there. I don't think so, but I do think it comes potentially next year, you know, maybe early 29. So there's another leg higher coming, but it's going to take some time to get there.
Interesting. Great conversation, Andy. Thank you so much. So if today's conversation resonated with you, and you're, well, looking for a more thoughtful, strategic approach to navigating markets like these, we encourage you to continue this conversation. Reach out to the Quantum team, learn more about Quantum Life powered by ORG, and then see how these ideas can be applied to your own planning. And as always, the goal isn't just to keep up with the market, it's to stay ahead of it. So thank you for watching, and we'll see you next month.